So what are some tax strategies for sole proprietorships? Of course, sole proprietorships are unincorporated businesses. They're different from corporations. Corporations have more options, more flexibility when it comes to tax strategy than proprietorships do, because there's no real separation between the owner and the business when you have an unincorporated business like a sole proprietorship. But there are still some things that you can do to reduce your taxes. The first thing, and this really applies to any type of business, but it's making sure that you're claiming all your business expenses. Basically, every expense that you have that's being used for business or partially for business, you should claim properly on your taxes. And again, if it's just partial, you should only claim the portion that you're actually using for business, but claim everything that's actually used for business. When you claim these expenses, they go against your revenue to ultimately reduce your taxable income. So if your revenue for your business for the year was $100,000 and your expenses were $40,000, then your taxable income is $60,000. Whereas if you missed out on, claiming $4,000 or $5,000 of expenses and you didn't claim those on your income tax, then your business taxes are going to be higher because your net income is going to be higher, when in reality it should be lower and you just didn't properly claim all those expenses. So that's number one. You're going to want to make sure that you claim every legitimate business expense that you can. The second one, and I'm speaking to Canadians here, would be utilizing an RRSP account. So that stands for Registered Retirement Savings Plan. And I think when I say that term, people just think of retirement and they think, oh, I'm in my 20s, my 30s or 40s. I'll worry about retirement when I'm in my 50s or whatever. But the name is kind of misleading because that RRSP account can be used for many things. I utilized it in my 20s and it was super beneficial to me. So the way an RRSP ultimately works is for every dollar that you transfer into your RRSP account, your taxable income is reduced. So if you have a sole proprietorship and you're earning pretty good money and you're finding you're paying a lot of money into taxes and you want to find a way to reduce that, if you're earning more than you really need, what you could do is transfer some of that income into an RRSP account. So let's say you generated $100,000 of income for the year and you really only want $80,000 to live off of. The $20,000 is just kind of a bonus to you, but you're paying taxes on it and you don't really want to. You could transfer that $20,000 into an RRSP account, and then your taxable income falls by $20,000. So that $20,000 that you contributed to your RRSP account is no longer taxable. And so if your personal tax rate is, let's just say 25% to keep it simple, you just saved $5,000 in taxes by simply transferring that money. So rather than giving $5,000 to the government, you get to keep that because you made that transfer to your RRSP account. And that RRSP account can be used for other things other than retirement. I mean, you can use the home buyer plan where you buy your first home using that money you contributed to your RRSP. Or if you're owning your own business, maybe you want to take some extended time off work. And so maybe 1 year your income drops quite a bit. You could withdraw some of that money in that year where your income is lower, and it will face tax when you withdraw it in that case, but you'll maybe be in a lower tax bracket because your income for the year wasn't as high. So there are multiple ways that you can withdraw those RRSPs and at least reduce the amount of taxes you're paying when you do withdraw it. And another option for tax strategy for sole proprietorships would be utilizing the new FHSA account, which was just started in April 1st of 2023. And that stands for First Home Savings Account. So that is created for people that don't own a home. In some cases, it's okay if they did in the past, but there's certain criteria for that. Typically, it's for people that are going to be first-time homebuyers. And it's very similar to the RRSP homebuyer plan in that when you contribute money to it, everything you contribute reduces your taxable income, and then you can later withdraw that money to purchase your first home. And then when you withdraw it, you don't have to pay income tax on it as long as it's for an eligible home purchase. So those three things can be really beneficial if you use them correctly. So claiming all your legitimate business expenses, contributing to your RRSP account, and contributing to an FHSA account are all really good options to reduce your taxes as a sole proprietor. And then besides that, there's another option called the TFSA, which stands for Tax-Free Savings Account. And this is treated a little bit differently because with this account, you put money into it that you've already paid taxes on. So it's not going to reduce your income tax. What it does is it allows you to put after-tax money into an account, and then in that account, it can grow tax-free. So you could just leave it in a high-interest savings account, you could buy GICs, you could invest it into mutual funds or stocks, and if you're getting capital gains on that investment, you're not subject to income tax on it. Whereas if you're just doing the same thing through a regular savings account and not going through a TFSA, then those capital gains are subject to income tax. So there's 4 options there that can be really utilized to reduce your taxes as a sole proprietor. And I hope that's helpful. If you have any questions, just let me know in the comments below. And if you want to book a one-on-one consultation with myself for business management consulting, I will leave a link to that in the description section.